It's Tuesday, February 2nd. This is The Street Live. I'm Catherine Ross, and I am joined, as always, by Jim Cramer. Jim, I was reading your colleague Andrew Ross Sorkin's column on how we could perhaps limit the amount of manipulation in the market. And one suggestion that he had was forcing hedge funds to disclose their short positions. Do you think that this would actually help, and could it impact the overall market?
Well, as a hedge fund manager, I always thought that we should. There's no difference between short and long positions. There should be nothing secretive. Everyone should be at equal footing. Andrew, once again, correct. Now, one of the things that there is, though, we were able to track very closely the position size and how much it costs to be able to maintain the position. And obviously, there are people who outsmart themselves. I mean, sometimes we have to analogize away from stocks to understand what this Melvin Capital did. They kind of, they came in with a game plan, and their game plan was to cause basically what I regard as being the demise of a company, if possible, because you wouldn't have had such big position. And then on the other side decided to, we're going to gun it. And there were some very smart people, a couple people at Reddit, who realized there could be unlimited losses here because there wasn't enough stock to borrow. I think if everyone disclosed their short position, what would happen is that they would be a little bit more circumspect about taking on that kind of position. But shorting has a function. And there are many people, including my daughter, who say, "Hey, Dad, are shorts bad?" No, when Karen Kramer and I traded together, we tried to run a book that had a great deal of shorts. There's a video that has plagued me. That's on I block everybody who does it, by the way. That's run from my old friend Aaron tasking me, where I described nothing I did because I didn't trade futures, about how people can manipulate the market down. Again, everybody who prints it, I block. There's someone who probably puts it out constantly. I enjoy blocking it because it is a memory of how I tried to describe, and the New York Stock Exchange looked into everything that I claimed about how people manipulate stocks down. And the New York Stock Exchange was very interested in what I had to say because it was the way people do it, not the way I did it. But it would all be prevented if there was sunlight the way that Andrew's talking about. So I applaud what Andrew's doing, and the people who want to constantly bring up things that they think I don't like. It's a waste of time because I block every one of you. I'm from Philadelphia.
Jim, there's a lot of frustration and anger around GameStop right now, and that's very evident on Twitter at least. But to stay objective here, I want to just look at the stock since Monday, where we watched it trade above 300, and now it's below. It's around 110 a share right now. Yeah. So some investors are going to stick to holding this stock, and that is their right. But for anyone who's getting nervous about the stock and perhaps jumped in when the stock was trading near its 52-week high of $483 a share, what is your advice specifically for them?
Well, it got to be a Braveheart situation where people had to hold, and it became ideological, became highly emotionally charged. And those things are all the things I have a call tomorrow for action alerts. All the things I preach you can't do. What I tried to do, and the methodology I use with my head writer and only writer, Cliff Mason, was we looked at the golden days when the stock traded 50 to 60, and that was when they owned the model. You bought hardware, you bought the games, you bought physical. And they were able to make a lot of money. And then they were kind of upended by what Activision Blizzard, Take-Two, which we own for Action Alerts, and EA did, which was they went for downloads. Now, it really hurt those companies when they did it, but they had to swallow the pill. And that left GameStop with very little to do. So Paul Raines, the late CEO, switched to a swag model and a membership model. That was not able to make up for what happened. And then they had a critical shortage in 2017, 2018, where they totally misjudged Christmas because they didn't realize that direct-to-consumer model had overtaken them. They have 5,000 stores. We don't really know what to do with them. They have leases. They have obligations. Their balance sheet is not what it was because they bought back almost half the stock. And then a new guy comes in, and he's very exciting, Ryan, and he's got a plan, but we don't know what his plan is. And the insiders were doing some selling. I don't know whether that was right or ill-advised, but they had a chance to be able to raise a lot of capital so that they could have been able to maybe buy a chain of gaming palaces, or maybe buy a gaming company, or maybe become much more oriented toward exchanging a product a la eBay. And they didn't take advantage of that. Finally, I will say that their silence is suboptimal because there's been so many material moves here. I've called them many times. I always offered my venue of mad money. I think that's the way you disseminate, and they chose not to. But they are exceedingly nice people, Catherine, and I think niceness matters.
So, Jim, watching Mad Money last night, it was nice to see the focus on names that weren't Reddit-driven, simply because some investors are not driving into these trades just because they're being covered from SNL to CNBC. So let's dive into how these investors can better tune out the noise and approach their portfolios as the media continues to focus on WSB and GameStop.
Well, what we've done in Action Alerts is what I did for years as a professional money manager, which is identify themes. Now, why do we do that? We identify themes because stocks go down. And when stocks go down, we want to be able to try to figure out whether we should buy them or sell them. So take GameStop. Why wouldn't that be part of my theme? That only works as it's going up because it's a short squeeze. As it goes down, we try to figure out whether it's worth 50, whether it's worth 5. We don't know. But when you buy a stock like DuPont and it goes down because of misinformation about how there's an exchange ratio versus IFF, where now our members, if they chose DuPont as part of their menu, own a lot of DuPont, which a lot is earnings power, then we can say, listen, it went down, but you buy more, which is what we did today. The broader, and that's because that's an industrial play. It's a reopening America trade. But when I started yesterday, I said, look, we have themes, and I always like to be in keeping with the times. What was the number one theme so far through earnings season has been the shortage, the incredible chip shortage. And the only way to alleviate that is to buy machines from Lam Research, which is the number one way, stock have been down 100, or buy machines from Applied Materials, like KLA 10 quarters, some very good numbers, because Taiwan Semi, because there just aren't enough chips. Why not? Because if you go back to the excellent conference call of Liam Griffin at Skyworks on Friday, which, by the way, was the best quarter so far this year, he talks about Internet of Things, he talks about telemedicine, he talks about the autonomous driving, he talks about 5G. The demand for chips far exceeds the supply, and the only way you can alleviate that bottleneck is to be able to buy capital equipment. We're not very good in this country at doing that. We've ceded a lot of it to Taiwan, hence why I've been very concerned about China. Don't want them to take Taiwan back. But it's a long way of saying that these themes are such that if Skyworks came down, NXP, if that came down, Texas Instruments, you can buy. We had a number of e-commerce ideas. You can buy if they come down because e-commerce isn't going away. As long as interest rates are going lower or staying low, housing is good. We know that there's healthcare. We had Thermo Fisher on last night. What a terrific stock. And then once again, I default to the menu that we offer for club members because all these are geared toward themes that we think can withstand any decline that's related not to systemic risk, that's different, but to the regulatory risk, that what was pointed out by GameStop. Systemic risk is a 2010-2009 issue. We certainly hope, by the way, that SPACs don't get to that point. But though that means that it's much harder to buy a Home Depot or a Lowe's. A UPS, we had UPS as one of our best, and I have Carol Tomei on tonight. I knew that she would deliver. That stock is worth far more than it's trading right now. But the reopening trade is Disney, and we've got that. And we have themes that if they come down, we can say, you know what an opportunity to go buy more NLOC because, Norton LifeLock. Why? Because cybersecurity is such an important point. So what we're trying to do, Catherine, is make it so that stocks get cheaper when they go down. But not all stocks. We're trying to identify the ones that do, and those are the ones we're recommending.
So Jim, looking at M&A activity, this morning there was a very exciting acquisition announced. Uber announced that it was going to buy DRIZLY for $1.1 billion. Now, for those investors who are not aware, DRIZLY is an alcohol delivery service. But Jim, not only did you sit down with Uber and DRIZLY CEOs this morning, but you also are a restaurant owner. So for your unique perspective, for delivery, as we continue to deal with COVID-19, does this make Uber stand out against Grubhub and other delivery apps?
I'm so glad you mentioned that. We were, for Bar San Miguel, which I own, we were a caviar shop, and caviar is owned by Square, and then that was bought by DoorDash. And Tony Zhu has done terrific things for small business, being able to give us breaks, not me personally. I'm sure people say, oh, Kramer, it's too scatological. I don't want to say that people say that. But the profit margin at a bar and a restaurant is really geared toward liquor. And if you order let's say you order some of our best tacos from Bar San Miguel and we send them to you. Well, they don't travel that well. They're not like Chipotle, which I have on tonight. And if there's no alcohol, we lose money on every single delivery. So what happens is we get a bad name and we can't satisfy the people who really want alcohol. This deal, I think, should make it so that we can send margies to you with tacos. The margin's better. We still have to pay the VIG. I will look immediately into having an Uber account. We intend to reopen, we're mothballed by Cinco de Mayo, May 5th. But this was welcome news because anytime we can get alcohol to people, as long as it's done responsibly, then we have a chance to be able to at least break even so that we can stay alive. And we we're small business people, and we employ people, since we're mothballed, we haven't been able to do anything. But this is a very positive thing, Catherine, because Uber demonstrates repeatedly that they're doing so many great things. The priority delivery is terrific. Also, I think they're thinking about doing ads, movie trailers while you're waiting. So we needed this. And frankly, I know a lot of people say, well, Jim, why do you own a bar? Well, we had 7 good years. And I loved sitting at that high top and ordering my mezcal. It's been a dry January, very, very tough. Now it's dry February. But this is welcome news for anybody who's used to the Cuomo fries issue. And the Cuomo fries issue was, if you just sold liquor, they would shut you, the health department. But as you stuck some fries in there or a taco, you're able to do it. So Drizzly's going to make it so that we can take advantage of that, obviously away from site. Now, just, once again, last point on Bar San Miguel, our money's made at the bar. If you only have 25% people, then we're not going to make any money. Maybe this will help us stay alive. What we really need to do is have ventilation to monitor airflow using carbon dioxide monitors, and recognize that it's an aerosol issue, and that is not yet. There's such a let's say a run on science, so to speak, during the previous administration. There are real hardcore issues about viral load. If they're identified and you can have ventilation open, and I've been in touch with Professor Prather, who's done more work she's at UCSD on aerosol than anyone. She's been involved with that mass competition I was involved in, and I'm quite confident we can open in a safe way, but not necessarily a profitable way.
So switching back to the outskirts of this Reddit story, Robinhood CEO Vlad Tenev is set to testify in front of Congress, and there is concern that Robinhood's raising $3.4 billion. Jim, how can all of this impact Robinhood's road to an IPO?
Well, I think that they could obviously SPAC it. Everybody can SPAC it. Vlad, I've known Vlad for a very long time, and Vlad is from he has the best app there is. Very algorithmic. Did they have the controls? Sometimes when you grow to 17 million people overnight, you're not going to have the controls. Is he well-meaning? Of course. And I think that he needs to get some people in there. He's trying to do that, who really understand what naked shorting means, who really understand what suitability of customers means. Has to invest a lot more money to be able to handle the overload. They didn't. A lot of people want to put blame. I mean, blame is a tough thing. I've been blamed for a lot of things. I mean, what it really is that it was an incredible success. It remains a success, but it's going to be difficult for Vlad until he is absolutely certain about all the terms that are involved with securities trading. Because you don't want to be in a situation where you say, well, listen, we don't allow naked shorting and calls. And then someone who knows something says, yes, but do you allow the underlying call that you're long? Do you allow people to sell that and not monitor the naked call? And I think that terminology may actually be above the ken of Vlad right now. I'm certainly hoping it isn't. But that's where you're going to get tripped up. His knowledge of the business is not as good as his app. But I think he'll get up to speed. He's a bright guy and he's a fast thinker.
Jim, your mad dash this morning was UPS, and it reported earnings and said that Amazon represented 13.3% of its total revenue in 2020, which is up from 11% in 2019. Does this percentage make you more bullish on UPS, or is it actually a bit of a concern?
Well, I think that, the proof is in the pudding. The numbers were extraordinary. A lot of people felt that there was a period right before that I had to kind of intercede where there were some series of articles that said that UPS was letting down clients. And those articles were, let's say, I try to find a diplomatic term. How about lies? And UPS was doing an excellent job for all customers, including Amazon. I think it's quite a credit in their head that a feather in the cap that they actually were able to make money being a partner of Amazon. But remember, this is not a regular company. This is a special team. Those of us who live in Summit, New Jersey, know that our kids are very proud to wear the brown hat because they get hired at Christmas time. Carol was, of course, one of my favorite CFOs. When she was the CFO of Home Depot, she's figured out a way to make money. The volumes were incredible and the amount of money they made. It's done. This is not the UPS that just loses money, making up in volume, but losing money. It's making money. The international numbers are really terrific. Should the stock be up 20, 30 points? Well, it's hard to do that in a day. But Carol has defied everybody. Now, let me just speak for a second about Carol Tomé. I thought Carol Tomé was one of the finest CFOs. I also thought she was one of the finest business people. She came out of retirement to run this company. She wanted to run it in a way that was leadership bent and that was team bent. They've always had good team, but they needed at the top someone with rigor. And Carol has rigor to spare. She may end up being in our top 10 CEO list on Mad Money.
Wow, that's quite the praise. Jim, let's talk about another CEO that you mentioned this morning, which is Stop Trading. You mentioned Palo Alto Networks and Nikesh Arora. So you said that this stock is a winner. So based on that comment alone, Jim, what level would you buy?
Well, one of the things I'm working on for a piece tomorrow for our club membership meeting is, what do you do when you have a big win? We had a big win with Nikesh Arora. We thought it was terrific. It was at Palo Alto, but then we got concerned that Palo Alto was too involved with what's called on-premise, and given the fact that on-premise has been so bad, the leases, whatever, because of COVID, we thought he might be passed by Zscaler, which is cloud native, by a CrowdStrike, cloud native, Okta, cloud native. I mean, they're really built for the cloud. What we didn't recognize was, well, no, that's too doubtful, too doubting. What I didn't anticipate was that Nikesh would move so radically. It was so radically toward acquisitions that made it so that they're good for both on-prem and for cloud native, and it worked. So I think the answer is, and this is what I'm struggling for the piece tomorrow, is when the facts change, you have to change too. Even though we sold the stock, we made a very big killing. We should have gone back when it was clear that the strategy had changed. I feel the same play with PayPal. There's a couple others where the strategy changed, and what we should have been able to say to members is, we sold this too low. But the strategy changed, we're coming back. And that lack of flexibility for action alerts is really about ego. I mean, you have to tame your ego. You don't want to say to people, hey, listen, I sold this wrong. But selling it, and it's also, by the way, very hard to keep on a great position. We've been able to do that with Facebook and with Amazon. We've been able to do that with Alphabet, which reports tonight. Amazon reports tonight, with Apple. But I didn't do it with Palo Alto, and I didn't do it with PayPal. And I think it requires some study and some soul searching. And that's exactly what I'm going to do. Palo Alto's a winner.
So, Jim, I know that a lot of people are going to get excited about this next segment because I do want to talk to you about Ford. And you've been cheering Ford on both this show and also on our Action Alerts Plus Daily Rundown show. Yesterday, Google and Ford announced a 6-year deal for in-car connectivity and cloud services. Is this a catalyst for Ford stock? And while you give members of AAP an investing strategy, give us a sneak peek into your thoughts on Ford at this moment.
Well, first, an analyst, I'm not going to mention his name, he downgraded Ford to a sell the other day. And why? That's because that static view that Farley, the CEO, it can't really accomplish anything. It's at the mercy of whatever. But at the mercy of making enough Broncos, maybe at the mercy of not having enough chips. But what Jim's trying to do is leverage the incredible installed model he has and being able to do a service model, which obviously, as we know from Apple, is much bigger margins. They got popular cars. Incredibly popular trucks, lucrative trucks, electric truck next year for the F-150, my favorite truck and America's favorite truck. They're not making cars, but they're selling cars in places that they used to lose money routinely. And so we end up with a situation where here's a man who's embracing technology. He picked Google. That's a great partner. And he's making it so that there could be a much better cars, much better trucks, better stream. And someone's leaving this company. I mean, Jim Farley's not of the same, Jimmy Farley is not of the same cloth as previous CEOs. He's basically said, listen, I love cars and we're going to make the best. I love trucks. So people who want to leave right now, this is very, we have a nice game for it. This is one where we can take the gain. And again, it would be very short-sighted. So I think people, if they look at what we're recommending, they should own Ford. And they should own Ford because Jim Farley is bringing that company very much into the 21st century. By the way, I'm not meaning to slight Mary Barr at all. She is doing remarkable work too. We're also blinded by Tesla, and I understand that. Tesla's incredible, but Ford is a very interesting stock to own, and I continue to recommend it.
All right, and with that, we're going to wrap up this show for today. But Jim, you do have a very exciting Action Alerts Plus members-only club call tomorrow that investors need to tune into, especially in this market. And I want to give a sneak peek to our viewers right now. We're about to head on over to our Action Alerts Plus Daily Rundown show, which is exclusive for members on actionalertsplus.com. But we are going to take a look ahead of earnings from Alphabet, and you're going to want to know what Jim has to say. So with that, Jim, thanks for joining us today, and members and viewers, thank you for tuning in. I'm Catherine Ross, and we'll see you tomorrow.